Why JPMorgan warns. Silver will crash back to $50 in 2026. In the world of precious metals, few assets carry as much intrigue and volatility as silver. Historically overshadowed by gold, the white metal has erupted into a dramatic price rally in late 2025 and early 2026, briefly crossing all-time high levels near $100 per ounce before tumbling sharply. Yet amidst this roller coaster, one headline has grabbed global investor attention. Today, we breaking down exactly why one of Wall Street AS largest banks issued this stark warning, what the underlying data and market forces are saying, and what it could mean for individual and institutional investors alike. This isn't just a story about prices. It's a narrative about market psychology, supply versus demand, speculation, industrial usage, and the broader macroeconomic backdrop shaping financial markets in 2026. The silver surge, a historic rally. Before we can understand the warning, we need context. Throughout 2025 and into 2026, silver experienced a staggering rally, gaining well over 100% in value year over year as prices soared from the low 30s to near the $100 level. Analysts attributed this meteoric climb to several factors: safe haven demand, industrial demand, and speculative flows and ETF activity. This convergence created a powerful virtuous cycle: rising prices, more headlines, more buyings, rising prices. JPMorgan's warning explained. So why would JPMorgan issue a warning that silver could crash back toward $50 per ounce in 2026? To answer that, we need to delve into the bank's 2026 silver price research and risk analysis, averages versus extremes. In a February 2026 research paper, JPMorgan Global Research projected that silver could average around $81 per ounce in 2026, more than double its 2025 average, but made it clear that this projection depends heavily on several variables that tells us something important. While average price expectations are higher than before, the range of possible outcomes is very wide. That's where the risk scenario comes in: mean reversion and technical pressure. JPMorgan analysts highlighted the role of mean reversion, the idea that after an extreme price move, financial markets often correct back toward long-term historical averages. After silver skyrocketed over 100%, there's a strong statistical pull back toward normal price levels, often meaning as much as a 40-50% correction. Underlying factors that could drive a crash. Let's break down the key reasons JPMorgan and other analysts are even considering a scenario where silver halves from recent highs. 1. Lack of structural base support. Unlike gold, silver does not benefit from consistent central bank purchasing, which acts as a structural price support, because central banks prefer gold. That means if investor sentiment shifts, silver can lose support much faster than gold, allowing deeper declines. 2. Volatility and liquidity risks. Silver has historically exhibited higher volatility than gold. During extreme rallies, liquidity can thin out, meaning when large holders decide to sell, prices can plunge rapidly because fewer buyers are available. 3. Supply and demand dynamics. While industrial demand is strong, analysts warn that high prices can reduce demand growth because manufacturers seek cheaper alternatives or innovate around silver usage. For example, in solar panel manufacturing, rising silver input costs could accelerate adoption of silver-free technologies, potentially eroding a major source of demand over time. Silver versus gold, why the divergence matters. Another way to understand JPMorgan's caution is by looking at silver relative to gold. Gold hit record highs throughout early 2026, surpassing $4,700 per ounce, driven by central bank buying, inflation hedging, and safe haven flows. Even JPMorgan projected that gold could reach about $6,300 by the end of 2026, signaling strong underlying demand. Silver's rally, however, looked more like a momentum burst than a structural trend. Some analysts describe it as a meme trade-like phenomenon, where traders pile in simply because prices are rising, causing a feedback loop that isn't grounded in real economic fundamentals. This divergence matters because gold has deeper, broader sources of demand. Silver is more tied to industrial cycles and speculative flows, and a shift in market sentiment tends to impact silver more dramatically than gold. This makes silver more prone to sharper corrections. The crash scenario, what would it look like? If silver were to retrace to around $50, this wouldn't be unprecedented in commodity markets, especially after a parabolic run. Historical precedent. Commodities often overshoot in rallies and then fall back into a mid-cycle equilibrium price. A 40-50% retracement after an extreme rally isn't unusual, especially when speculative excess is present. Technical breakdown. Chart analysts have cited trend exhaustion patterns that, if confirmed, could trigger accelerated selling from leveraged traders and algorithmic positions. This can magnify price drops quickly. Investor psychology. Once prices begin to fall sharply, fear often overtakes fundamentals. Weak holders exit, margin calls trigger liquidations, and prices can spiral downward faster than expected. Behavioral finance tells us that fear tends to amplify sell-offs far more than greed fuels rallies. The bullish side, why some analysts disagree. But it's not all doom and gloom. Many analysts, including some at JPMorgan, still see structural demand supporting silver prices above historic levels. Supply deficit fundamentals. Even with price volatility, fundamental supply-demand dynamics, especially in solar, EV infrastructure, electronics, and medical equipment, remain robust. ETF and retail participation. ETFs, like the iShares, Silver Trust, SLV, have seen heavy inflows, signaling sustained investor interest, not a black and white outlook. Importantly, JPMorgan own forecasts. Don T suggests that silver will definitely collapse, rather that a severe downturn is within the range of potential outcomes. The forecast band is wide because of uncertainty in demand elasticity, macro pressures, and geopolitical forces. In other words, a plunge to near $50 is possible, not guaranteed, particularly if the rally unwinds sharply. Now, what this means for investors? So, what does this warning mean for you? Risk management is key. If you hold silver physically or via ETFs, be mindful of volatility risk. Look beyond headlines. JPMorgan's warning is about probabilities and risk scenarios, not a guaranteed crash. Diversification matters. Precious metals can hedge macro risk, but no asset should dominate a portfolio. Watch macro signals. Inflation expectations, interest rate moves, dollar strength, and industrial demand shifts will be key drivers. To summarize, Silver AS' incredible rally in 2025-26 was driven by both industrial demand and speculative capital. JPMorgan warns that after such an extreme run, silver could retrace toward $50, roughly a 40-50% correction through mean reversion, lack of central bank support, and volatility pressures. This scenario is within the realm of possibilities, not a certainty, and forecasts are showing a very wide range of outcomes. Ultimately, silver's future price trajectory depends on supply and demand fundamentals, global monetary policy, investor psychology, and macroeconomic trends, all of which remain uncertain in 2026. If you're trading, investing, or even just watching silver prices, understanding both the bullish narratives and risk scenarios is crucial. JPMorgan ES warning is in part a definitive death knell, but it should remind investors that markets can swing sharply in both directions, often for reasons that go beyond simple supply and demand. Thanks for tuning in, and remember, in volatile markets, knowledge is your greatest asset.